This house in Seattle, Washington is listed at $1.025 million, and we're going to walk through a real mortgage quote to talk about what it would look like to buy this house. What would the numbers look like if you were the one buying this house? How much would your monthly payment be? How much cash would you need to bring all in? And would you be able to qualify? What income would it take to qualify for the loan? And hopefully, since it is a real mortgage quote, it'll just give you more confidence early in the process than you might be able to find with an online mortgage calculator, and just give you more reliable numbers before you get really deep into the process. So let's get into the numbers. All right, so I've created two different quotes here, two different scenarios. One over here is a 30% down scenario. You make a 30% down payment, and over here you're making a 60% down payment. And I'll show you how the numbers differ in each scenario. For both of them, I'm using a credit score of 740, just so you know some of the assumptions I'm making coming in. And then as we walk through the numbers, these are reliable numbers. This is a real mortgage quote that I'm pulling based on real numbers, our live data. But that doesn't mean they're going to be the exact numbers you end up getting. It's not going to be the exact interest rate you end up getting. It's not an advertisement for the exact numbers for you. These are based on several different factors, based on the day, the time of the quote, and several different factors that are going to influence your numbers, just so you know coming in. But they should be a really good expectation of what to expect coming in. So let's walk through the 30% down scenario first here. The monthly payment here is $5,896, and that's made of 4 different components. So since we got to 30% down, we don't have mortgage insurance, but we do have an HOA here for this particular home of $124 per month. And then there's 3 other components here. And why am I including the HOA here? Just so you know, that's going to be, even if you are paying that on your own, paying that directly to the HOA, from the mortgage perspective, it's going to be considered part of your monthly payment, and it's going to influence how much you can qualify for. So $124 on the HOA, homeowners insurance of $175 per month. That's an estimate that will vary depending on who your insurance provider is and what kind of coverage you're getting, but that is a pretty reliable number for what to expect for this price point for our area. That's a pretty common number that we see. And then taxes of $824 per month. The taxes on this place are obviously pretty high. And that number is drawn from the county website for 2024, so it is the actual number that you can expect for this property. And then principal and interest of $4,773, and that is based on a loan amount of $717,500 and an interest rate today of 6.999%. Again, not an advertisement, but that is kind of where we're at as far as interest rates generally. We tend to be a little bit lower than the average of what you'll find, but that is a pretty good expectation of where interest rates are at generally right now. 717, that loan amount, just so you know, if you are wondering if that's a jumbo loan, we're just below the jumbo loan limits. Jumbo loan is somewhere like 770, 776 or something like that. So we're just below the jumbo loan limits right here, so we are still conforming conventional there. Monthly payment, that just means, this right here just means principal and interest only. If you're just looking at that, it's like your monthly payment from the mortgage perspective specifically, not including anything that's specific to the house. It's just your principal and your interest. That's why they're showing that there. Points or credit here. Not going to get into a ton of detail on what these are. Basically, points are a fee you can pay up front in order to get a lower interest rate, and credit is the reverse of that, where if you are willing to take a higher interest rate, the lender will give you some cash to cover some of your closing costs. So if this number is negative, that is a credit. If it's positive, that means you're paying points, and you're going to be paying those as part of your closing costs to get a lower interest rate. But in this case, we have a credit of 172, and without getting in a ton of detail as to why that number is what it is, basically lenders tend to just price their interest rates at with a certain amount of points or credit. Very rarely will they show one. Typically they show one that's the closest to zero. So they show a certain interest rate, and it'll be the closest one to zero in terms of 0 points or 0 credit, but very rarely, at least in terms of getting a quote, You're not going to get just 0 points, literally exactly. Sometimes when you go to get an actual loan, you may be able to get that with some lenders, not all. But that's just the way interest rates work, is they show the interest rate and how much points or credit it takes to get that. And typically you're not going to get one right at 0. But just for context, this is very close to 0 in the sense of what's it actually doing to the interest rate. It's not like you could have been at 6.5%, but you got $170 in credit, and so you bumped up to 6.999. To drop down to 6.5%, it probably would have taken several $1,000s in points for this loan amount. It would have taken, I don't know, my guess right now, it depends on lots of things, but my guess right now is probably somewhere between $5,000 and $10,000 to get down to 6.5%. So 172 is functionally 0 in the sense that it's not doing anything to this interest rate. It's not really moving the needle there. Let's pop down here to other closing costs, $15,254. When you come to get a mortgage, you're probably aware of this, especially if you're not a first-time home buyer, which in both of these cases, I'm kind of assuming you are bringing a lot of cash to the table, which means you probably are selling a house that you have some equity in. You've probably bought a house before. But if you're not familiar, closing costs, you have to pay closing costs on top of your down payment. And typically there's two different components of closing costs. One is basically you're paying the fees and the services involved in getting the loan itself, getting the house itself. You're paying all the people who are helping make that happen, and all the things like that. The other is what's called prepaids, where you have to pay some things like prepaid interests. You have to put some of your sometimes you have to put some taxes and insurance into escrow ahead of time, because it takes the lender a little bit of time to get you set up on your monthly payment. So sometimes there's a significant amount of time that elapses between when you close on the house, when the house is yours, and when you actually start making your monthly payments, and you have to cover those costs with closing costs. So those are the two components there. That's going to vary. What your closing costs are going to vary depending on your loan amount, and it's going to vary depending on several factors, but your loan amount and your purchase price are going to be very impactful there in terms of what your actual amount of closing costs is. And so with a pretty high loan amount and a high purchase price, we end up with closing costs somewhere close to $15,000. If you're a little bit lower, generally just kind of as a broad number that we use for estimating, if you're in the greater Seattle area with house prices where they are around here and loan amounts of several $100,000, we generally estimate maybe $10,000 to $12,000, but again, that's going to vary. So estimated cash to close of $323,949. And that is your down payment of 30% plus your closing costs of $15,000. All of that the cash that you're going to have to put into escrow in order to close this deal is $323,949. All right, let's look at the 60% down and see how the numbers change now. So the monthly payment is now $3,850. We've dropped down almost $2,000. HOA is still the same, $124 per month. Homeowners insurance still the same, $175 per month, and taxes still the same, $824 per month. Those are all the same because those are dependent on the house, not the loan structure, not the loan amount, not any of that. Principal and interest is now $2,727, based on a much smaller loan amount of $410,000 and an interest rate which stayed the same of 6.999. We are taking slightly less of a credit to take that interest rate, $98 now, and other closing costs have dropped down slightly because we have a smaller loan amount, $14,266. So that's going to impact your loan amount size. Your loan size is going to impact your closing costs. So now we have about $1,000 less in closing costs, and estimated cash to close of our 60% down payment plus our $14,266 means we have $630,461 that are going to be due at the closing table. right, so now let's answer the question of how much income would it take to qualify for this loan. Now, you probably have a good sense looking at these monthly payments of whether you would be comfortable taking it on based on your income, but qualifying is another question. And it's another question for two reasons. One is because sometimes people are comfortable taking on possibly more of a monthly payment than they would qualify for, even if their qualifying income is the same. If the lender views your income as the same way you do, and so we have to realize what our qualifying is. And another reason it's important is because typically the lender doesn't view your income the exact same way you do. The lender needs to decide on a final amount of income that you make based on what you can prove, and based on certain standards that the lender uses to figure out how much income they're going to deem that you make. And those are rarely the exact same. And typically, if it's not salary, if you're making anything besides salary, they're going to be pretty different, those numbers, than the amount of income in your mind versus the amount of income in the lender's mind. If it's salary, there's some overlap there, but if it's anything besides salary, if you're not a W-2 employee on a salary, then those numbers are going to be pretty different. So the way that lenders figure out whether you can qualify for a monthly payment is they look at your debt-to-income ratio, your DTI. And your debt-to-income ratio is your total monthly debts divided by your gross monthly income. And your total monthly debts, they take your total housing payment, and they add that the housing payment that you're trying to take on, plus any other monthly debts you have, student loan, car debt, any other monthly debts. They add that all together, plus your new housing payment, and they divide it by your gross monthly income, and that number needs to be less than 50% for a conventional loan specifically. It looks a little bit different with FHA and VA. It's still very similar with FHA, but there's a nuance there that I'm not going to get into right now, and then VA is pretty significantly different. But with conventional loans, that's how they figure out. If your debt-to-income ratio is less than 50%, then typically they will approve you for the loan. But again, that's assuming that's using the number that they decide to use as far as your gross monthly income, which is your income before taxes. But again, it's your income in the lender's eyes. Now, if your income does qualify, which you can look into other videos as far as what income typically qualifies in for conventional loans. For a typical mortgage, what does it take for income to qualify? You can look into that in other videos, but typically, salary is pretty straightforward. Typically, salary has a pretty good chance of just qualifying. Your whole salary is going to qualify, or it has a pretty good chance. Other pay structures, obviously they're usable. People get mortgages with them all the time, but it looks a little bit different, and there is typically more of a disconnect between what you think you're making, what you're budgeting for, and maybe what you're really actually going to make versus what the lender is going to use as far as your qualifying income. So just be aware of that, but whatever number they end up using, basically it needs to be double the total monthly debts you have in order for you to be approved for the loan. So $7,700 per month and $11,792 per month, and then that's going to be $92,000 per year in this scenario that you're going to have to be making, and $141,504 per year. Now, if you are applying with a spouse or if there's someone else on the loan, typically you can pair both of your income together to get a total usable income, but a lot of times there's strategy behind whether you should do that. Like if you were able to qualify just with this income, and sometimes it's strategic. You can get better pricing by leaving the other person off the loan for whatever reason, for various reasons. So just know that you do typically have the option of using your combined income to qualify if you're both on the loan, but it's important to think through whether you should do that and know the implications. So hopefully that's helpful. If you want to ask any questions, or if you want to get a quote of your own on a house that you're looking at, or just start to see what it'd be like to get a loan, please do reach out. My name is Landon Buta. I work with Cleveland Street Mortgage based in Bothell, Washington. We do loans in Washington and Idaho, and we love working with new clients. There's a lot of information in the description down below that you can see what it's like to work with our team, see what our process is like, and if it looks like it'd be a good fit, something you're interested in. Again, we do loans in Washington and Idaho, and we love to work with you, so please do reach out.